Um, Thank you for showing up this morning to listen to our presentation about the markets. I've been in capital markets for 30 plus years, and I've been through many different crises and weird market times. We are very much in one of the most unusual times right now. What we're hoping to do today is share with you just a very candid kind of background of what's happening, why it's happening, but really inform you and give you information and facts so that if you're talking to a potential home buyer and they're looking at the media headlines and they're confused, they're scared, they're uncertain, is you can take those fears and can help them manage through those fears and uncertainties with facts and help a person make a very well-informed decision if they should buy a house right now, but also answer the questions they would have about just, the different media headlines. So we will share this PowerPoint with you. There's a few slides that have a lot of information. I'll talk through those more quickly in the interest of time. But if you can't see the slide, you will get a PowerPoint if you would like at the end of the day today. As we go through this, if there's questions you have, I love questions. Please raise your hand. I'm sure if something's not clear or there's a question you'd like to talk about, I'm sure probably half or more of the room has the same questions. So I welcome those. I love this to be as conversational as possible. And I hope at the end of the day, as you walk out of here, it was a very worthwhile hour of your time in terms of the information you walk away with. But very much encourage questions. As Shayla mentioned, I do spend a lot of my time in Washington, D.C., meeting with policymakers, both at HUD, different regulators, Fannie Mae and Freddie Mac. And so I'm involved in a lot of policy issues. And at Guild, I'm responsible for our capital markets, which means how we price our loans, how we sell them, and also the programs we offer. So hopefully I can give you at least feedback to a broad range of questions that you might have. I get the right button here. I think, Katie, maybe you're driving the slides. Where am I?
You want the stool?
A stool's fine. No, I'm fine. Yeah. Katie, if you could advance the next slide if you're driving, or my clicker's not driving. All right, what we want to arm you with today is just to help you have a really solid response, or just help you have the right facts to answer the two questions of where interest rates going and is this a good time to buy a home? And if there's other questions you're getting, I'd love to hear and talk about those as we go through. And just as a group, hopefully we can all walk away smarter at the end of the day today. So my clicker's still not clicking. We're going to pin Shayla to the wall maybe and have you be the clicker. Okay, so here's the media headlines that if you probably even looked the last 24 hours, probably every one of these was a headline in one media or the other. The Fed, if the constant media headline is the Fed's raising rates, the Fed's raising rates, the Fed's raising rates. So we'll talk about what that means. We'll demystify what that is. There's been a lot of conversations in media about a recession's coming. It's going to be one of the worst recessions in decades. So to me, the worst recession in decades was 2008. And that was not even 2 decades ago. That's, just 12 years ago. So we'll talk about that. There's a lot of media headlines saying the yield curve is inverted. Like, what the heck does that mean? We'll demystify that and talk about that. And, conversations about interest rates and mortgages are skyrocketing and Chicken Little and panic. And we'll talk about that as well. So as we go through this, let's just demystify the first two things, which will tie to a lot of conversations, because the answer to the question of where interest rates are going is based on the Federal Reserve and what they do. And what they do, how it impacts the MBS market. These two things will be the answer to the question on where interest rates go. So we'll go forward. So the Federal Reserve, they are the central bank of the United States, and their main job is to make sure the United States economy runs very smooth. In a perfect world, they would smooth out booms and busts of economic cycles and have just long periods of very slow, boring economic growth. So that's their mission, and they have different tools they can do. And one of the tools they can do is they can control the Fed funds rate. So what the heck is the Fed funds rate? Every bank at the end of every day has to have a certain percent of their assets in cash sitting in their bank account when they close their books at the end of every day. And some days, if you own a bank, you wake up in the morning, one customer comes in, makes a large withdrawal, another one makes a large deposit, your cash balances go up and down each day, and you can't always predict it. So as you get close to the end of the day, if you're a little over or a little under your cash target, what you can do is you can borrow cash from another bank across the street, and you borrow it overnight. You literally borrow the money about 3:30, 4 o'clock in the day, and you pay it back first the next morning. That's a one-day loan from one bank to another, and that's called a Fed funds rate loan. The Federal Reserve determines what interest rate those banks pay each other for that one-day overnight loan. That's all the Fed funds is, a one-day bank loan. The Federal Reserve can control what that rate is, and by moving that rate up or down, they basically increase or decrease the cost of funds for banks. So if you're borrowing one-day money as a bank and that rate goes up, your cost of funds goes up. So if you're a bank, you probably charge more for the other loans you make in other businesses you do. So it just gives the Fed a tool to control interest rates, but they're only controlling one-day loans. They're not controlling 1 year, 10-year loans. They're just controlling one-day short-term loans. That's all the Fed funds is. So MBS, it's an acronym you're going to hear a lot in the industry. It stands for mortgage-backed security. Mortgage-backed securities are issued by Fannie Mae or Freddie Mac or Ginnie Mae. Why is this important to all of us in the room? Is interest rates every day and every lender's rate sheet is based on the MBS market. The MBS market is a giant bond market in New York. People trade and invest in these bonds, and those prices go up and down every day. If the price of an MBS bond gets a quarter point better tomorrow morning when we all wake up, every lender's rate sheet in the country has a quarter point better price. That means whatever discount or fee a borrower is being charged or rebate they may have been getting gets a quarter point better. So the reason the MBS market's important to all of us, it is what drives interest rates for mortgages in the country. So when the Federal Reserve does different strategies, they impact the MBS market. And when they impact that market, that's what drives and impacts our mortgage rates. It's literally a one-for-one driver of mortgage interest rates. So people talk about blah, blah, blah in the news, and this is hitting the MBS market. This is exactly why it's important to us. So again, you'll get all these slides so you can read through the details more. Let me just sort of pause there and see if there's any questions anybody has so far on anything. And just raise your hand later if something pops up. So let's do the answer of like where things are going kind of depends kind of how we got here. So let's do a really quick backwards look. COVID, March of 2020, that's when COVID really hit the United States. If you look the month or two before that, we really weren't quite sure how serious COVID was. Were we taking this too seriously, not seriously enough? March was when the whole country went into lockdown. That's when the panic set in. And people were literally thinking, is this going to be Armageddon? Are we going to have this incredible virus? The whole country shuts down. Zombies are walking in the streets. This is going to just be the end of the world. So it was a big, big time. And the Federal Reserve jumped in with the US government, and they did massive, massive stimulus to try to help the country and help the economy get through what people thought might be one of the worst crises we've ever seen as humans in our history. So a very uncertain, scary time. There's lots of things the Federal Reserve did and the government did. There's two things they did that really impacted the mortgage industry. Is the first thing is they started buying MBS and started buying treasuries. They were buying $40 billion a month of MBS and just putting it in their balance sheet. So by doing that, they were buying almost half the amount of MBS being issued every day by our industry. So they became a big buyer. And by doing that, they just bought a ton of MBS every month, and they pushed up the price of MBS, and that's what made interest rates go so low. That was the number one thing they did to drive rates really low. Their buying of MBS directly resulted in mortgage rates going to the 3% and high 2%. It was their buying of MBS was the thing that did that. They also bought 10-year treasuries, which helped other interest rates go lower, but their buying of MBS was the reason mortgage rates went down to the 2 to 3% range. When they did this, they also slashed the Fed funds rate down to zero. They wanted banks to basically have a zero cost of funds to help banks lower their interest rates for car loans, for bank loans, any other loan they might do to any other person or business. They thought if we can lower interest rates, it'll help the economy, help people save money. It'll put more dollars into the economy and put more dollars into people's pockets. If they can refi their loan, save a monthly payment, those extra dollars in their pockets will get spent into the economy and make the economy stronger during a really, really scary time. The Fed had two objectives in their strategy. The first objective is they wanted to bring the inflation rate up to 2%. If you want to have a perfect economy, where should inflation be? You don't want it to be really high or really low. If you have it really high or really low, the economy doesn't work as well. If inflation is zero, people have no incentive to spend money. People just sit on their cash, and a lot of cash just sort of sits on the sidelines. If you have inflation at 2%, people don't want to leave money just sort of sitting there because it's getting 2% less in value every year. It just sits there as inflation eats away at it. So a 2% inflation is gentle enough to encourage people and businesses to not let cash just sit idle and invest it somehow into the economy or spend it on something. So when this was happening, the inflation rate was about 1% right before COVID hit. So they wanted to bring it up to 2%. That was their first objective. Their second objective is they want to bring the unemployment rate down to a full rate of employment, which they didn't say what that percent would be, but most economists consider a full rate of employment about 3.5–4%. There's no official definition of it, but you don't ever get to zero unemployment. There's always some humans that are changing jobs for whatever reason that has nothing to do with the economy, just their own personal situation where they're changing jobs. So those are the two objectives they wanted to do. So this is mortgage interest rates. So this is from 1975 right here, and you can see how high and how low they went. If you look at the very, very far right, that very, very bottom, that's that 2 to 3% rate. So in 2020, they definitely brought rates down. Prior to COVID, rates were sort of in that 4%-ish range in the years before that, and they came down into the 3s and the 2s. So they definitely brought mortgage rates lower. So they were successful there. Next slide. The unemployment rate, that's not a blip. Unemployment rate was in sort of the low 3s. And in April, it went to 14% in 1 month. This is when people thought the world's ending because they thought, well, it went to 14 in 1 month. Where's the next month going to go? To put this in context, the highest unemployment rate ever in US history was during the Great Recession in the 1920s. It got up to 24%. So we got more than halfway there in 1 month. People thought this is where we're going to have Armageddon. The whole country's going to be unemployed. People will be on the streets with bayonets and stealing money and food and everything. And it's going to be crazy. You can see it spiked up, but it came back down. But this is why people were in a complete panic when you're the Federal Reserve or you're in Congress or in the government, and you see that April report come in and that huge spike. It's come back down. We're there. So where are we today? Unemployment is, as of the December numbers, was 3.5%. So they definitely hit their target on that. Here's the takeaway. The Fed was in a panic. Everyone was in a panic. In hindsight, they will admit they overstimulated the economy. They put too much stimulus in the economy, which is why the job market is actually too strong now and inflation is too high now. So that's the conclusion of these efforts. The unemployment rate is at 3.5–4%. Here's the powerful part. There's 10.4 million jobs in the United States today posted unfilled. There's not that many people that want to go back to work. There's more jobs posted than people that can go back to work. The total number of people on unemployment is less than half of that. So we have an incredibly great jobs market, which is great if you're a worker looking for a job, but it's not good for inflation because if employers can't find enough people, they have to raise wages to attract people. When they raise their wages, tongue twist, they pass those costs on. So whether you're a fast food restaurant or whether you're a service provider, if you have to pay more for your employees, you charge more for the products you manufacture or the services you provide. So a tight, strong labor market creates inflation pressure. And the Federal Reserve, when they bring inflation down, they want to cool the jobs market. That's one of their objectives. Inflation actually came out this morning, and inflation is dropping, but the core inflation rate hit 6% last month, and it dropped to 5.7% this morning. So it's coming down, but it's still way above their 2% target. You can tell it's clearly above it. So inflation is something that is actually really simple. It's the big driver. So I just want to do a quick demystification of what inflation is. It is not some crazy economics concept of some balloon inflating big and smaller. Think about literally as your Amazon cart. If you bought an Amazon batch of goods that represented the average human, it's literally a monthly shopping cart that the average person would spend. So it includes everything you would buy: clothing, shoes, food. It even includes rent costs, gasoline costs. It's a basket of goods that the average person would buy every month. And you literally look at that basket and you say, what would it cost to buy everything in that basket in the month of December? And you look at that same basket in January and say, did that basket go up, down? That change in that basket each month, that's inflation. If everything in that basket went up 1% the next month, you'd say that's a 1% monthly inflation rate. It's literally, think of it as a basket of goods and that price month to month. The other thing about inflation is you have just an inflation rate, which is the total rate, which is everything in the basket. But also you hear this word core inflation. What core inflation means is you take that basket and you just take out of the basket food and energy items. And the reason they do that is food and energy item prices tend to bounce up and down a lot every month. And if you're looking at trends, it can be misleading which way inflation is really going, because food and energy prices can kind of hide the trend as they bounce up and down. So economists, when we look at long-term trends, like to just use what they call core inflation, which is the entire basket minus food and energy prices. So the inflation coming down is critically important to where interest rates go. So this is the CPI inflation that came out this morning. This was before this morning's number. So you can see it started coming down on the far right. And that's a 6% number on the far right. That's now 5.7 for core inflation. So this is a really key part of the answer to the question about where interest rates are going. So here's the analogy to answer the question on interest rates. The Fed overstimulated the economy. Inflation got too high. So now they're trying to cool the economy. One of the ways they can cool the economy is they want to raise interest rates. So they are raising the Fed funds rate. So when you hear these news headlines about the Federal Reserve is raising the Fed funds rate, that's exactly what they're doing and why they're doing it. They're hoping by raising interest rates to banks that creates a lift throughout the entire economy of everybody raising interest rates. And they're hoping that businesses, when rates go higher, businesses are less excited to expand their businesses. And they hope that consumers are less excited to spend their money. They literally want to create grumpy consumers and grumpy businesses. So I think that part, they've been very successful. So that's a key part. So what they did is Fed funds were down to zero. So they started raising these. So these are here's in March, started raising these, and here they went up plus 25, 50, and so on. The analogy is we're driving in a car down the road. The car is the economy. We're in the car, and the Fed's the driver. And we're telling the Fed, hey, going a little too fast, slow down. Keep moving forward, but just stay in control. And the Fed is hitting the brakes. Each of these is the Fed slamming on the brakes pretty hard to try to slow the economy down. And for a while, they were doing this, and they're hitting the brakes. Inflation kept going up. And this was creating a little fear in the bond markets. People thought, wow, these rate increases are not slowing down the economy. They are not slowing down inflation. We have to do more and more rate increases. We're literally at a crossroads. In the next few months, the question, can the Fed get inflation under control? It's yes or no. They've been hitting the brakes. This is not a hypothetical. They're trying this right now as we're talking. They've already hit the brakes several times. If inflation over the next 3 months comes down every month like it did today, that will give the markets confidence that each news month when the report's a little bit lower, it's not some random blip. It is a clear trend line driven by the Fed. If that happens, it will give the markets confidence that yes, the Fed's strategy is working and they can get inflation under control and interest rates will drop. So the markets are betting on this. This is my personal opinion that this will work. If this does in the next 3 months, we're sitting here April 1st, if we have 3 months behind us showing a continuing trend down, in my opinion, the markets will be confident this is coming under control and we won't have a very scary scenario. The scariest scenario is they can't get it under control and they have to keep raising rates. If inflation, which is in the sort of 6 to 7% range right now, if you take out the core, if that stays there or goes even higher, let's say it goes to 8%. If we have an economy with inflation at 8% that's not coming down, mortgages will be above 8%. If that doesn't get under control, we'll be looking at mortgage rates in the 8-9+% range if they can't get under control. So the mortgage investors, economists, they know we're at a crossroads. We will find out in the next 3 or 4 months if these brakes are working or they're not working. If they work, big sigh of relief, investors will calm down and interest rates will drop. My personal opinion, there's an 80-90% probability that this will work. If it works, next April, we will have lower mortgage rates. My personal view is rates next April could be down into the 5s, maybe high 4s. The Mortgage Bankers Association and Fannie Mae are also predicting the same. So I think we're going to have a very positive spring. At the same time, it's the typical for most parts of the country is when the home buying season picks up, and also human beings are just more optimistic in spring than they are in the winter. Just psychology of humans. Question in the back. I'm sorry. So I'll repeat the question for the group and for those online. So the question is, what's being consumed each month that's driving the price up? So there's a predefined basket of goods for CPI. So, and each item has a weight. So for example, the cost of housing, which is either rent costs or mortgage costs, is about 42% of the basket. So it's a big chunk of it. So what they try to replicate was, what is the average person, how much of their budget goes on food, what percent of their budget's on clothing, shelter, and so forth. So it's not just like, so there are weights that try to represent what the average person would do. So a big driver of what's been going up has been the cost of shelter. So it's higher rent costs and the result of higher mortgage rates for home buyers has been driving up the monthly number. So what they do is they survey hundreds and thousands of humans to see what they're paying each month in either rent or in a mortgage. So as interest rates have been rising and rents have been rising, those, for anybody who has a new home, their monthly payment's going up. Obviously, a person who's had a home for several years or refied, their payment's not going up. But for those people renting or for those people who have a new home, their monthly costs are going up over the last 12 months. So that's probably the biggest part of the basket is the cost of shelter. But automobile costs, gasoline costs, food costs are all part of it. And it gets pretty detailed. I mean, they literally break out what people spend on tobacco. And actually, strangely enough, cannabis is actually part of the basket. So not sure where cannabis prices have been going, but I would say that the main answer to your question is shelter costs. Question in the back? The question was April of what year? I'm thinking April of this year. Yeah, I think we are 3-4 months away from having a drop in rates. This morning, when the better number came out, the mortgage market, the MBS market did have an improvement about of a quarter point this morning. So the market will get there if this continues. It won't all of a sudden happen in 1 month, but I think between now and April 1 in the next 90, 120 days, that we will see this improvement. All right, next slide. Just to demystify this, an inverted yield curve, you hear this in the press, and people say whenever the yield curve is inverted, that predicts a recession is coming and bad times are coming. So if someone asks you this question, I just want to demystify this. So first of all, what the heck is a yield curve? A yield curve is literally, you take treasury interest rates you can get treasury bonds ranging from 1 day up to 30 years and anything in between. So what you do when you talk about a yield curve or you create a yield curve, you literally take treasury interest rates from 1 day treasury bonds up through 30 years, you put them on a graph from 1 day through 30 and then from 0 up to there. So in a normal market, a yield curve goes up, it's upward sloping. And all that means is a long-term loan usually has a higher interest rate than a short-term loan. is pretty straightforward. If you're either investing money or borrowing money longer term, there's more risk things can go wrong the longer term you have. So usually longer term loans always have higher interest rates than short terms. So today, if you look at interest rates, and this was from a few days ago, this shows on the far right, if you can see the very far right, those are yields on Treasury securities. So if you look at a 2-year Treasury security, the yield's 4.2%. If you go down to the higher and higher terms, you see it actually goes lower and lower and lower, and a 30-year loan is less than the 2-year loan. So that's what they call an inverted yield curve. And all that means when you say it's inverted, just means long-term rates are lower than short-term rates. That's all that it means. The reason that happens is people think inflation is high, but it's going to be high for a few years. It's going to come down. So if you're going to invest money only for 2 years, that means inflation will probably be high those 2 years. You're going to want a little bit more interest if you can do a 2-year investment to kind of offset what you think will be high inflation in the next 2 years. But what this is saying is the markets are betting inflation will be coming down. If the markets thought inflation wouldn't be coming down, would even get worse, you would see the longer term rates have much higher rates than the short term rates. So, you know, people talk about inverted yield curve predicts 100% of every future recession. There's nothing magic that it predicts anything. It's just what happens. When people think a recession's coming, people start, putting a discount for longer term rates. There's nothing magic about it. To me, it doesn't predict. To me, it's like the weatherman saying it's raining when it's already raining. The yield curve inverted means recession's probably coming. Next slide. So is a recession coming? Actually, go back. So on this page here, and this might be hard to see from the audience, and you can see this on your PowerPoint at home. I hope this might be one of the most helpful pages to share with a potential home buyer, because what it does, this shows from 1945 up to present, every one of these gray bars is a recession. And so recessions are a normal part of an economic cycle. Recessions are actually a really good thing for economy. It's sort of like a forest needs forest fires once in a while just to kind of clear out the underbrush and keep the forest from becoming overgrown. Think of recession as the same thing. It helps if a price of some asset became overpriced or overexuberant, it helps sanity come back into a market, prices correct, get back to where they should be in balance. So first of all, I wouldn't fear a recession. If you can see here, this red line, this is the unemployment number. If you look back right where the cursor is, when we had the Great Recession, you can see unemployment got up to almost 10%. I'll do a prediction right here. There's a really good chance that 2023 or 2024 has a recession. I wouldn't be scared about it, and this wouldn't be a reason not to buy a home. If we do have a recession, the unemployment rate, which is in the, call it like the mid-low threes, maybe it goes from 3.5 to 4.5. Maybe most it goes to 5%. Unemployment rate has to go higher if we have a recession, and has to go a little bit higher if inflation will come under control. But as a country, if our unemployment rate goes up to 4.5% on a relative basis over history, it's not that bad of a position to be in. Not great if you're that human who got laid off from a job to get to that 4.5%, but as a whole for a country, it's a very, very strong place to be if our unemployment goes up to 4.5%. Also, what's important about this graph is that as you look at recessions, the world doesn't end when you see recessions happening. It's like unemployment goes up and then drops after every gray bar. Next slide. So this is the easiest myth to debunk. When someone sees the headline of the worst recession ever, or the worst recession in decades, you have to be talking about 2008. There was no other recession in the last 2 decades worse than 2008. So if someone's asking, will this be 2008 all over again? Here's very powerful things you can tell them, where it's not like sort of maybe, it's like absolutely will not be 2008, and here's why. And it's a fair question. If anybody's worked in construction, or if they or themselves or a family member owned a home, it was devastating to homeowners, and it was devastating to people in the construction as examples. And so they may have very real pain that they themselves or family went through. So it's a very fair question. If you look at exactly the most important reasons why 2008 happened, which are on the left, It is completely opposite today, not slightly different, 180 degrees opposite. I'll go through these really quickly. In 2008, we had too much inventory. We literally had more homes than we had households wanting to own a home. If you recall, in 2008, when it hit, we had entire new subdivisions where people would not buy the homes at any price. There just were no buyers. And we were talking about, should we bulldoze down these new homes just to bring inventories down? That was in 2008. Today, and the Realtors Association has great research on this, we are 4 to 6 million units short today of today's current inventory relative to demand for housing. And if every builder and their brothers and sisters were building as fast as they could, we could not build enough new homes to meet demand for the next 10 years. So just think about that. If we have more demand for housing than we have inventory for the next 10 years, when you have more demand than inventory, that will push up home values to be solid for the next 10 years. Doesn't mean you won't have blips, but you can have very strong support for housing. With respect to builders, so the question is the amount of cash that was injected into the economy still creating demand? And the answer is it'll still create demand even with rates are higher. As a comparison, if you look before COVID hit to after, the amount of cash sitting in consumers' pockets is $4 trillion higher. So if you want to look online to share it, the St. Louis Federal Reserve tracks, it's called M2. M2 is the amount of money that is in checking accounts or savings accounts or at home underneath your mattress. It's literally cash that people have, not businesses, but individual consumers, people have. That amount is $4 trillion higher now than it was before COVID. And that was the result of all the programs, whether rent forbearance, mortgage forbearance, different grants and loans, everything that happened to us as consumers. In total, we have $4 trillion more in our pocket. And to this gentleman's question is, that cash at some point will get spent. And if there's a scenario where the Fed's brakes don't work, that's the scenario, that $4 trillion of cash will create consistent consumer demand. As long as we as consumers are spending money to either buy goods or services, that will keep inflation pressure up. So the way you slow inflation down is you reduce and cool consumer demand, you slow the jobs market down a little bit, and you hope that factories can buy goods without supply chain disruptions that create bottlenecks and push up prices. If you can do those three things, that's how you bring inflation down. So in 2008, underwriting for loans was horrible. Stated income, no income. People were getting qualified for loans and they had no ability to repay it back. Today couldn't be more completely opposite. There is no stated income loans out there for the most part anywhere in prime loans. Everything is fully documented. If anybody's done a jumbo loan, they're more than fully documented. So complete opposite in documentation. Third item here is pay options. Pay option loans had huge payment shock. The monthly interest rate a person was charged or their payment could literally double in 3 months, 6 months, or 12 months. And people literally, if they wanted to keep their house, they couldn't. Literally the payment was more than their income. So that payment shock was a huge part of why we had 2008. Today, there are no monthly ARMs. There are no neg-am ARMs. Most loans today are fixed rate loans. The few ARMs that are out there are 5, 7, and 10 when fixed rates. And so payment shock is about a 0 today, and it was huge in 2008. In 2008, people were taking out all the equity of their houses. In the years prior to 2008, people were literally doing refis, cash out refis every 6 months sometimes, and paying off credit card bills and just sucking out like all the cash and equity out of their homes. So when the crisis hit, they had no cushion of equity. They were almost underwater before it happened. I mean, you could do cash out refis to 90, 100%. You could do HELOCs to 125% and put yourself underwater. Today, it's the opposite. There's been very few cash outs. Those 90, 100% cash out programs don't exist. Most all people have a huge cushion of equity. So even if a crisis does hit, they don't have the incentive just to mail in their keys and walk away. Even if they lose their job and it's a worst case scenario, it's better they sell their house through a realtor and not let it go through a bank foreclosure. And that's great for the human who can recapture their equity. And it's great for the neighborhood who doesn't have a zombie foreclosure boarded up in your neighborhood, which depresses your entire neighborhood. That's night and day different from 2008. If you got in trouble in 2008 and you wanted some help from your mortgage servicer to help you out, you would call your servicer, take 10 minutes for them to answer. They'd want 55 documents from you. You would send them in. They would lose them, have you resend them. They would then spend 3 months looking at them. They say, hey, the documents are stale, resend them again. And then 6 months later, say, okay, congratulations. We're going to give you a 10% reduction in your P&I payment. Well, you lost your job. You can't, that didn't help you with anything. So even though you wanted, you were in tears as you lost your home. Let's look at what happened in COVID. Complete opposite. You called your servicer, one phone call, all you had to do is say the word COVID, and you immediately, you didn't have to sign anything. You didn't send in a single piece of paper, and you didn't get a 10% reduction. You got 100% reduction in your payment. And they try to go for 6 months, but then you could go for 12, you could go for 18. You couldn't think of a better help that was more completely zero payment for 12, 18 months. So in my opinion, for the future crisis, when the next one happens, we're not going to have the 2008 horrible process. We'll have one that might look like what we had under COVID. I hope it has a little bit more of a threshold, like people who don't need it, don't just get it for free. But people who want to keep their home will have a way to keep it. Last point, we'll move on. A lot of people in 2008 were flippers. They bought homes that they hated. They would never want to live there, but they thought they'd just buy this horrible home and sell it for a profit in 6 months. There was taxi drivers in Los Angeles coming to Nevada and buying 4 homes at a time from a builder. And then the day they were finished, they'd sell them for a huge profit. They had no ability to live in those homes or pay the monthly bills for them. That flipper mentality is mostly out of the market today. And the people that own homes today bought them as a home to live in, not thinking to make a quick buck. So big mentality differences. That's probably a terrible graphic, but it's about interest rates. So let's talk about where rates are going. Yeah, you can all connect to that a little bit, I see. Next slide. So what will answer the question for where rates go? The first point will be the inflation rate. And that's what we just talked about. If the Fed's strategy works and that scenario of the 4 trillion isn't offsetting it, because if it doesn't work, the reason why it didn't work is we had too much cash in our pockets and we kept spending like crazy, even though rates were higher. That would be the reason it doesn't work. Most economists think it will work. The markets are betting it will. So I think the answer is yes. And I think it's an 80 to 90% probability, but we can't dismiss there's a 10% chance that it doesn't work. And as realtors or as mortgage professionals, that's something we should tell a person. They should have a very sober, open-minded view that this is not 100%. And we'll talk about how you can help a person get to that 10%, because there's actually a really great answer for that. The war in Ukraine, that drives up energy prices. That's hard to predict how and when that might end. And certainly a new strain of COVID hitting, strains of influenzas always mutate, and there's always going to be some new random one that happens. My personal opinion, I don't think we'll ever have a complete country lockdown again like we did. I think we will have bad future strains. I think individual people, whether you own a business or whether you're a consumer, will make our own decisions. We want to lock ourselves down and shut our business down or modify our business or work with masks and plexiglass or whatever. So I don't think we'll have a full lockdown, but I do think there will be certain future strains. And I think that's just a mathematical, inevitable outcome. If you want to put things in perspective, there's a hyperlink in here that has Freddie Mac's historical rates. It's a great thing to show consumers when they think rates are crazy high. The average rate over the last 50 years was 7.7%. So rates today are below their average. These are not crazy skyrocketing rates. It's from perspective of balance. If people ask you, when will rates get back to normal? And they want those 2 and 3% rates, very possible never. The Federal Reserve never intended for rates to get down 2 or 3%. In hindsight, they regret rates going to 2-3%. I would say if I had to do a prediction for the rest of our lives, for everyone in this room, the lowest rates we may ever see again might be in the 4s. And that might be rare. 5s, a range between 4 to 8 might be the relevant range for interest rates for the next 50 years. Where they are today. I don't know. Give me your info at the end and I'll see if I can get it and I'll share it with the group. I don't know. It's a great question.
The question was, is there a median rate? I have seen something that like 35% of homeowners, it's like 65% of people have rates below 5%.
Yes. Yeah, I'm sure it's out there. I don't have it, but there's a huge part of the country just sitting on pretty low rates. Right. And just for everybody to hear online, the question was the fact that people have low rates should really give another incentive not to walk away because you have an amazing low rate and you don't want to lose that. Yes.
That's a huge percentage of people who aren't gonna, I just was literally, I'm never gonna sell my house, and like, I'm sure a lot of people will never let go of those. That's gonna have an impact on the inventory in the coming years. Like, when do you think we're gonna start to really see the hit of that mistake?
So the question is, will people sitting on low rates give them extra reason just to stay put and not to move? And how will that impact inventory going forward? My answer to that, and just my opinion on that, is in the short view, I think that will be a constrained inventory. The question is for how short and how long. So I think two answers will drive that question. If you wanted to sell your house, what's the delta between your current rate and the new market rate? And how much time have you been there? Because a lot of people, the other thing that's going to be a very powerful force for purchase loans in the next 10 years is this future post-COVID work at home world where a lot of people have jobs for summer all the time they can work at home. And what that does is allows people to rethink where they live. For a lot of people, their current living location was a compromise where they needed to live to be close to work versus where they wanted to live. And so a lot of people, whether they're retired or may soon retire, or maybe they're not even retired at all and they're just starting, but they want to be close to beaches or mountains or family members, or they want to be in the big city, want to be in the country. A lot of people have the chance to reset where they live, more tax-friendly state. So I think people will be weighing the benefits, both financial and emotional, of moving versus, wow, I'm just saving a ton of money. So I think for the near future, that will be a constraint for people moving. Let's say 1 year from today, if people say, wow, I've had a really low rate, and I got a couple years out of it, but I'm not getting any younger. I got grandkids now. I want to go be close to them, or my happy soul, my happy place is someplace else. I think life is short. People will want to do that. And if if rates are in the 7s today versus the 2.7 they have now, that might be a big jump. Let's say rates come down to the 4s. I'm like, you know what? I've been here for a few years. I got my 2, I'll go to a 4. And, I'm in a happy place. I think they'll start breaking people loose, but it might be 1, 2, 3, 4 years before that constraint starts to go away. Next page. So literally, if that person is coming into your office tomorrow and asking your opinion about where rates are going to go, it's literally a really simple answer, which is, does the Fed strategy work? Yes or no? And it's not a hypothetical someday. It's like the Fed's doing it right now. And if 3 or 4 months from now, if inflation hasn't slowed down at all, the answer is no, it's not working. If it's a clear trend line down almost every single month, then we can say it probably is working. So like I said before, if it works, MBS prices will get better and mortgage rates will drop. So this is I hope, the most helpful slide for you to help talk to a borrower about timing to buy a home. So I'll go through this quick because I think we're probably running past time, but I always need a hook when I'm talking. Here's what I tell a borrower. If a borrower's asking you, should I buy a house now? Here's what I'm hearing. Here's my fears. Here's, I think, the facts you can talk to them about to help them make the educated decision. Don't be afraid of recession. A recession is a normal part of a cycle, and you could have a recession in the country and the real estate market could have little or zero impact. So I would not have a recession fear be the factor. Here's the other point I would make. If you're going to invest in real estate, you shouldn't have a short-term, day trader mentality. It should be a long-term outlook. If you're going to invest in real estate and your best friend's asking you, should I do this? You should have a long-term outlook. If you have a 10-year outlook to own real estate, you cannot take any point ever in history where 10 years later, home prices weren't higher, ever. Take the Great Recession, 2008, 10 years later, home prices were higher. So the way I would describe investing in real estate is home prices always go up and they always go down, but you always have more up percents and more up years than you have down years. So the way I describe it is a J curve. If you look at the shape of a J, it's a curve and you have some downs in the curve. You also have some ups. You have more ups than you have downs. If you look at real estate, either on a national basis or on a local basis, home prices always move in a series of J curves, which means there's zigs and zags, but the trend line moves up over time. So if you pick a 10-year period, you'll most likely get one complete J curve as an owner of that real estate, meaning you'll have a few years of down, which are paper losses. You have more years of up, which are paper gains. But by the end of the 10 years, prices will be higher. And you'll also have 10 years of amortizing your loan, which is about 1% per year. So at the end of the 10 years, you'll be higher. If you want to try and time the market, the most professional, brilliant traders in the world cannot time a market. Even if you're watching home prices like a hawk, you won't know when we hit the bottom till about 3 months after that's already in the rearview mirror, and you've already missed the bottom unless you randomly bought lucky. If you look at the person or interview the person who timed the bottom of anything, whether it's cryptocurrencies or home prices or anything else, the day they bought, they thought they were buying a falling knife. So what I would say, if your goal, if someone's talking about trying to time the bottom, there's a really good chance that you missed the bottom and, not sure what you achieved. It's great objective, but it's very hard to time the bottom. If home prices soften up, will they be soft for, did they go down 1% for 1 year, 2% for 2 years, 3% for 3 years? Nobody knows, anybody's guess. But the long-term trend for real estate is very powerful. And if you have a long-term outlook and you don't let the first year or two, keep you from getting into it, you're making a very sound investment. The other point I'd make is, I think today is one of the best times to buy a home. There's pros and cons in a seller's market versus a buyer's market. But if it's a buyer's market, you can take your time to make the decision. You can sleep on it overnight. The seller might give you a concession. Maybe they pay for an inspection, or they give you a percent, rebate, or pay some of your closing costs. The fact that you can buy a home, that's your home to live in, and you're going to wake up and brush your teeth every morning in that sink, in that mirror, and think about it, is very powerful. The surveys were done of people who bought a home last year. Over 20% said they bought the wrong home. Not just buyer's remorse, they bought the wrong house. They were in a rush, had a gun to their head, they had to put a bid in. So there's a lot of benefit in buying in a market like this. Next slide. This is a graph of home prices. You can look at this, and this shows, home prices peaking in 2008. If you just look forward 10 years, you can see they already had fully recovered from 10,000. Here's a more zoomed in, closer graph from 1965 to present. So it is a great long-term investment. And the only way you can lose is if you try to do a short-term flip. If you buy a home that you love and you're happy to live in for 10 plus years, you'll always be ahead 10 years later. So the other thing I would say is, we always talk about homes as just an investment, return on investment, return on capital. There's a huge emotional part to owning your own home and not have to worry about if your roof leaks and you complain to the landlord, they don't renew your lease. Or you fall in love with where you live in your home, you love it, and then they raise the rent and they have to move because you can't afford to live there. So the emotional security of owning your own home is an investment that sometimes we don't talk about. I'm a board member of Habitat for Humanity, and they've done studies of the children who went from renters to homeowners. It's amazing how much better the emotional health of children is and how they do in school and their emotional health from owning a home. And I don't know how you put a value on that, but I think as an industry, when we sell homes, it's easy to get into this like math of an investment and not talk about the emotional security and stability. You don't face rising rents. You can set down roots. I won't read through every point here, but here's what I tell you is the most important part you can tell them. In this industry, as either a realtor or as a loan officer, you can change a person's life if you can help a person move from a renter to a homeowner. It is the single best thing that a person can do to create financial wealth for themselves. And what are the pieces of it? The first thing is, if you sold a home today, and someone bought a home, let's say they paid a 7% mortgage rate. The first thing you should do as a realtor, as a loan officer, is say, congratulations. You've just locked in your monthly cost of housing for the rest of your life. It cannot go up if you do a 30-year fixed rate loan. It can only go down. So if you can afford the 7%, you wish it was lower. If you can afford it, congratulations. You've just made one key step to creating financial wealth. The rest of your life, your monthly cost of housing cannot go up. Compare that to a person who rents their whole life and gives away their income for their entire life that could otherwise be in their pocket. Second thing you're done by owning a house is you're now creating equity of 1% per year, regardless of which way home prices go and interest rates go. Third thing you can do is every time rates drop, you can refinance. Refinance for the rest of your life. Become best friends with your favorite loan officer. And every time rates drop a quarter, any small amount, refi. Do a zero cost refi and lower your cost. And every time you refi, that's more money in your pocket. That's more wealth you're creating. Those give you incredible benefits. And guess what? At the end of the day, you get home price appreciation as well. It is the #1 way to create financial stability and create wealth in the country and to create intergenerational wealth. The correlation between homeowners and renters and a person's wealth is an incredibly powerful correlation. And in times of uncertainty, if you're not sure which way rates are going to go, the most amazing financial tool, with casinos and gambling and odds, I'll use that analogy. It is the best financial instrument, in my opinion, any human can ever use in their life in the United States. A 30-year fixed rate loan that's prepayable. It is a heads you win, tails you win scenario. You can lock in your interest rate for the rest of your life and never go higher. Or if rates go lower, you refi for free and get out of it and get a new lower rate. It is literally, if you don't know where rates are going to go, let's go back to my math. He said, hey, this is Battany guy was talking and I couldn't understand half his gibberish, but he said 80% chance rates go lower, maybe a 10% chance they go higher. If I was buying a house today, there was no way I'd buy a house with an ARM loan today. No way. I would get a 30-year fixed rate loan. There's a 10% chance that rates go higher. I think my lucky stars, I got them rate at 7 if rates go to 9. And if rates go lower next April, like we're hoping, great, refinance. Get a lower rate then. It's like insurance against rates going higher. There's a 1 in 3,000 chance your house burns down in a fire. We all have fire insurance. If there's a 10% chance that rates go to 8 or 9, get a fixed rate loan and protect yourself. It's a way you can make a bet on interest rates. And either way they go, you win. If they go higher, you protected yourself. They go lower, you benefit. It's literally a heads you win, tails you win bet. Is there a question back there? I don't know if you could hear the question. Yeah, the question was, if you have a borrower at 7%, they probably have maybe some credit issues. So at least you can get them in, and if you can help them fix their credit, they could potentially refinance with a lower rate just by having better credit and get even more of a win if rates themselves go down. And it's a great way to be a rock star. But doing this, like if a person sits on the sidelines today and out of fear and uncertainty, they decide I'm just going to keep renting. And if home prices do hit bottom, maybe they've already hit bottom already. We don't know. But 1-2 years from now, they get back into it, or even 6 months, they get back into it. Well, if other people are coming in, now they're bidding against 5 people on the house and sellers are making less concessions, they may have maybe a tough spot. So, if you have a 10-year outlook, I would say it could be the best time ever to buy a house today. Question. There's nothing on this slide, but there is very powerful data out there. It's almost a 10-to-1 ratio on wealth between the average wealth from homeowner versus a renter. And it's also more acute based on minority status. I mean, it is one of the largest drivers of wealth in the country is homeownership.
Something I'll share is that David Battany interviewed his longtime buddy, Dave Stevens, who was the head of the MBA and all kinds of, this guy's another big major player in our industry for 40 years. We will share that recording and that slide presentation as well, because I know David is not duplicating some of the work that he did there, but some of the powerful stuff from that slide presentation is talking about demographic trends, and millennials, and that not only over the next 10 years do we not have enough inventory, so we're going to drive supply and demand, but the household formation growth that is coming just due to 33-year-olds in our country and the millennials that are reaching the buying age. It's just a really powerful fundamentals that are happening. So Dave and David went through that last month, and we have that PowerPoint is really well. It's a really good slide. And on that slide, he also talks about even by demographic, if you look at Blacks, Hispanics, whites, single, married foundations of renters versus homeowners, and it's staggering. Literally, when we looked at that slide, David, I wanted to run through a wall. I really felt like what we do matters so much. And from that moment, we all got together at Guild and said, we're on a mission. We want to help 100 renters become homeowners. We want to help 100 renters become homeowners, because how much does that change the legacy and the family tree of the wealth in that family by making that happen for them?
Yeah, and just to add to what Shayla just said, the average age a person typically buys their first home is typically age 31 or age 32. The millennial generation, we have more human beings today in the United States who are 31 years old than ever in history of the United States. It's a little over 4 million. And so just by the demographic wave of those humans coming into that age, we have a huge percent of humans that will be at that age where they want to buy a home. Also, I think the value of a home has gone way up. In this post-COVID world, I had friends in New York that worked in financial services, and they had their kids in daycare, they had their dogs in puppy daycare, and they had a little small 2-bedroom flat in Manhattan. And when COVID hit, they lost their minds. I mean, their kids, their dogs, and themselves were crammed in this little 2-bedroom thing. And so many people want space, not because they're afraid of zombies. They just don't, they want to have a backyard for a dog. They want to have space for kids to spread out. So people will be resetting. People who are retiring will have a 5-bedroom, may want to sell. And if you're going to be working at home, maybe you don't want to use your kid's nursery as your Zoom call center. And maybe you want to have a dedicated home office that looks professional. So I think there's going to be tons of people resetting either where they live or which house they live in their market based on upsizing, downsizing. So if you look at the demographics for population growth, look at demographics or just demand for housing, I would use Warren Buffett. When Warren Buffett makes a decision where to invest, he's not looking at short term. If Warren Buffett said, hey, this ABC company is the best company you could buy, it does not mean next week or next month their stock's going up. But 2 years, 5 years from now, their stock will be rock star. I would say housing in the United States is one of the best investments you can make, even if you're just a landlord buying properties. But if you are making a decision between renting versus owning, besides just the asset you own, the financial stability of not facing rising rents and having your monthly payment, part of it go to amortization of your loan, it is such a powerful tool that creates emotional and financial stability and wealth. It literally transforms a person and makes a family more stable. So if you want to make our country a better place, not just a happier place, but like a better sound place, if we can move renters who want to own a home and are financially and morally and physically capable of the responsibilities, it makes our communities way stronger. I'm a volunteer police officer in Los Angeles because mortgages are boring sometime. And one of the most happy days I ever had was I was at Fannie Mae and I won an award having the best affordable housing program of the year for the whole company. I got a little blue site in my desk. And it was just this nice theoretical thing. And I'm in a housing project in an area that has high crime, high poverty, and street gangs, and people shoot at the police. And no one in the housing projects ever talks to a cop, let alone a white cop. And I'm talking to a guy who is like a 30-year-old Black man, and he's like talking to me. He's answering questions and helping me out. I said, do you mind if I ask you why you're even talking to me? No one talks to me in this neighborhood. And his answer was, we have our issues. We need to work on them. But see this house right here? This is the first house I've ever owned in my life. I just bought this house. So you know what? I care about the people smoking dope in the corner. I care about the graffiti on the wall over here. So I'm going to work with you to make things better because I care about this home I live in. And I was like, wow, what if everyone in the neighborhood had that same mindset? So I went back to Fannie Mae on Monday where I worked, looked up in the Fannie Mae database, that address, and guess what? It was a Fannie Mae loan. And guess what? It was part of that little Lucite deal that I won the award for. So for me, that was the universe saying, hello, connection. So this theoretical concept of home ownership, I met the actual human that it connected to. So I then took Fannie Mae's database and I ran the whole neighborhood. It was like 99% renters. And I'm like, wow, what if you could go from 99% to 90 or 80% renters? And you had, even if you had 20, 30% of a market where they care about where they live and they care about schools, they care about quality of life, it makes our neighborhoods better. So we had racial equality and tension be a big thing of the country the last few years. I think one of the best ways we can solve it is by creating higher minority home ownership rates and not having people feel like you're on the outside looking in on our communities. So I think it's one of the best ways to make our communities stronger and safer as well. So that's my little silly ending story.
So we'll keep this party going for 10 more minutes and get you all out to make a bunch of calls and call your database. But I did want to ask David about the MBA and the forecast. So many of you might have been here last year, saw David speak. We had a forecast from the MBA that said we'll end the year with rates in the high at 4.6%, I think. We did not end the year at 4.6%. So is the MBA even setting a forecast this year? How do you forecast when there's so many changes happening? And like, what does the outlook look like for this year, since we're still in this 80 to 90%, this will work, could not work, but just overall, what's the projection?
Yeah, so the MBA and pretty much most economists were predicting rates to go higher. No one thought they'd go as high as they did. And the reason was the war in Ukraine was a curveball. People didn't expect it. And inflation was driving this. The way to think about inflation interest rates is actually very simple and straightforward. If you want to invest your money and you want to buy a bond that pays you 6% interest, well, if inflation's at 3 and you're getting paid 6% for the next 30 years, you're earning 3% over inflation and you're getting ahead by 3%. If you buy that bond at 6% and inflation's at 9, you're losing money every year. That's a really bad investment. And so think about inflation rates as they go up and down as a rising tide that lifts all boats. And as inflation goes up and down, it lifts mortgage rates up and down. And so the number one reason that economists' projections didn't come through was inflation went higher than people thought it would. So doesn't mean every forecast is incorrect. Here's what I'd say about forecasts in general. No matter how smart human beings are and how much great data they have, it's really hard for humans to predict anything, weather patterns, financial patterns, anything with accuracy beyond 2 years. So people have forecasts for everything, but it's really hard to predict anything past that. So the MBA economists and also Fannie Mae economists, which are very well respected and usually pretty close to middle of the road, they're both projecting interest rates drop. Fannie Mae says into the 4s. I think that's a little optimistic. I'm thinking 5s, my personal opinion. The MBA is closer to my view of like low 5s. But what Wall Street is betting is the Fed fund rates, that there's at 4.25 where we are right now, they stop about 5%, maybe 5.25. And that they have 8 meetings throughout the year. And that's when they make the decisions to go up or down or stay the same. The markets are projecting that the Fed will stop raising rates probably in March, and that they might hold for a while. And if we do get a recession, they'll start lowering rates. So just the fact that the Fed says we think inflation is under control and we're stopping, that's going to be a huge milestone for our industry, because that's telling investors, you know what, this fear of inflation eroding your future returns, we think it's turned the corner. The Fed thinks it's turned the corner. Just the fact that it's coming down, maybe it doesn't come down as fast as enough as you'd like, but the fact it's going down is what's important. If that trend goes, the sigh of relief with MBS investors will be huge, and the prices will get much better, in my opinion. And a lot of times you feel like you have Kool-Aid drinking optimistic scenarios you just hope for. I think this is literally, from a probability scenario, an 80% probability of happening. And I'd love to be here on April 1 and you can say I'm a big fat liar, or I got lucky and I was right. But I think it's going to be a tough winter, lack of supply and high interest rates and just a lot of negativity. But I think in the spring, be more positive signs in the economy and inflation and lower rates.
And what about volume? Where are we seeing purchase volume going? What's that projection look like?
I'll get the latest MBA forecast. I don't know off the top of my head their volume numbers for what they're showing for the spring, but they are showing a pickup in volume, and they are thinking with the lower rates, to the question earlier, that some people on the sidelines today, because they don't want to go to a 7% rate, if rates go into the low fives or even high fours, that'll bring people off who otherwise would have sat in the sidelines. So they are showing a pickup in volume. I would say if you want to work in the real estate industry, the next 10 years are going to be very, very strong. The demand for housing, the lack of supply is going to be a great investment to own. And the people who can find a way to get in will be a very good decision for them. And we're going to have lots of innovative financing and underwriting tools for the future that don't exist today to help people that don't fit into the current models. And so there will be lots of future home buyers, especially in markets that have a higher minority concentrations. We'll have some markets will have majority minority home buyers. So I think there's strong 10-year fundamentals behind the real estate industry as a good investment and people needing financing and needing to buy homes. So there was a comment about getting some T-shirts. If you can throw tomatoes, in case it's wrong, it'd be perfect. I'll wear it. Tomatoes. So get the T-shirts. Yes, sir. Question front. So the question was the people who sat in the sidelines in 2022, what happens if things do get better and they come off the sidelines and how that impacts inventory? I think the buyers will come back before the inventory comes back. So what that will mean is demand will go up even higher, which is why I think, home prices went up 18% nationally last year. That was too much. There has to be some correction. So people talk, right now the big debate is how much they correct. Is it 1% down for 1 year, 2%, 2 years? No one really knows. I think it's going to be in the lower end because as that demand comes in, that'll be more demand pressure. So I think we'll have some correction in home prices. I don't think we're going to have like a 2008 dip, and even close to that. So short-term forecast, and this is my opinion only, is that in the spring, more buyers start coming in. There will be some inventory that comes in because there's people who listed their homes for sale, didn't like what they saw and just came off the market. So I think there are some sellers who are hoping and timing as well. So I think there'll be some inventory coming back. But I think to your question, which is like a perfect question, more demand from buyers will come in than people bringing back in, which to me means home prices will start to stabilize or might start going up. It sounds crazy to say, we had 18%, people are forecasting recession and dip, and we're saying as soon as, this spring, they can start coming back up. That's, to me, that's not a scenario to rule out. That's a very possible scenario.
Barbie.
And they've got inventory that sits there and they've got to make these numbers. And so you got to get in there and, sorry. So you guys, they've got to make their numbers. So they've got Genuine has we have rate buy downs that we've paid a lot of money for that are going to start expiring, and these builders are going to see this money that they've invested to try to help this buyer, and they're like, crap, man, I just paid all this money and it's going to go right out the window. So get to know, they talk about inventory, they've got the pricing, they're giving cash back, they're paying. It's not just us. I mean, it's just about every builder on the market right now. It's just that we're better because we're local. So, but make sure you use us, and we're paying 2.5% again because we need our realtors back. So take advantage of this, you guys. You're missing out. If your inventory is not there, give your people a call and figure out what they've got.
And I will add to what Barbie's saying, because I'm involved with a lot of builders and in a lot of builder meetings every week and talking to a lot of owners and the whole bit. A lot of the builders have actually slowed down all their starts. So a lot of people are going, oh, well, I'll just wait and I'll wait and I'll wait. Well, no, the builders have a certain amount of inventory that they committed on pricing and subcontractors and everything else 9 months ago. And that's why they have the inventory today. But they've put the big pause button about 3 months ago, which means there's going to be a huge lag in new home inventory coming on the market at the same time that the buyer rush comes in too, right? So it's really, I mean, like now's the time. It's really hard for buyers to see this, but whatever we can do as salespeople to get face to face with people, use these graphs and charts. We will also follow up with the David Battany interview, because that has another cycle to it, talking about supply and demand as well. So I think this is the total combo.
And just to comment on builders, like, please, please, please take care of your builder relationships. We need builders right now to ramp up their building. And to your points, they're not there. And it shouldn't be a surprise. There was no industry that's more devastated in 2008 than the building industry. I used to work in construction before. I had a lot of friends are builders. They were just like bankrupt, wiped out. And so the builders today, some of them were here in 2008. Some of them may know family members were there. You can really understand why they're hesitant. They want to pull back when they hear these headlines in the media. But we are not building as fast as we can. If we're 4 million, 6 million units short today, if you look at like housing starts and building permits data, it's like 1.1 million a year. If we're short 4 to 6 million and we're only doing 1.1 million a year, we're not going to catch up as our population keeps growing. And that's why there's that 10-year outlook. So there will be a point in time when builders switch gears and they're going to start coming back online. And that's going to be really critically important. But if they come back online tomorrow, we won't have the inventory on the market right away until we get to the builds. So, for all of these reasons, we're going to have lack of inventory relative to demand for the next 10 years. So, but builders will be a big part of how we get there. So programs for builders, some of these manufactured homes that can be built, much more quickly and at lower cost will be a big part of the solution. So working with builders and helping them come back to the market will be key for all of us in this industry. So we need to help take care of our builders.
Andy Stewart, wrap us up. Final comment, question?
So the question was, with a lot of apartments being built for renters, do we see some of those being converted to owners? I think very much the answer will be yes. The same lack of supply of 4 to 6 million homes, it doesn't impact just home buyers, it also impacts home renters. So supply and demand with renting is like musical chairs. If there's 10 homes for rent and 12 people, guess what? Rents will be going up. So as much as there's good reasons to own homes in the next 10 years, there's also really good reasons not to be a renter for the next 10 years, because that same lack of supply will drive up rent. So I think the answer to your question will be more of a local market question, where in a certain market, is the demand for rent versus home buyers out of balance? And if it is, then we'll see conversions. I think it'll be more of a local market phenomenon where that happens more. But whatever it takes. I mean, there's lots of conversions of commercial office space right now in a lot of cities to residential, whether it's for rent or for buy. So there'll be a lot of creative ways people try to meet this demand, but we have very solid 10-year fundamentals behind housing and home prices.
David, any final thoughts?
Just to echo Andy's point, I love to have this be a dialogue. Hopefully you didn't feel like this was me talking at you. As you take these PowerPoints home, if you read through them, if there's things you really liked or things you thought don't make sense or you didn't like, I'd love to hear the feedback. And I think the more we share ideas, because a lot of these things up here were based on conversations we've had with loan officers and realtors about, what are the questions, what's the best, most honest way to answer it, where it doesn't feel like it's a bunch of Kool-Aid and propaganda, but like just giving people facts. Because in a market that was very frothy, like 2022, anybody could be an amateur loan officer, an amateur realtor, and get a lot of business. There's just so much business happening. These type of environments, this is when professionals really rise to the top. As a real estate professional, you're not just giving a person, here's your 5 talking points and just buy a house. And here's the propaganda reason why. It's like you're looking at each person's individual situation, their individual fears and worries. What's their life experience? Maybe they went through 2008 as a builder, or maybe they had a family member. So you want to address their concerns and their fears and give them very detailed, sober views of like, hey, this is what could happen. This is, 10% chance this could happen, this could happen. So they have a complete picture. The worst that can happen is we don't educate people and just there's a paralysis of analysis and they just don't move. And then they regret 5 years later, oh, I wish I bought a house back in 2023. So I hope it's an ongoing dialogue. If you have questions, if you have feedback, please reach out to your guild contact. We can either answer questions, we can incorporate your feedback into future updates, we can share data. The more as an industry we can help educate borrowers to understand the facts and how to manage this and manage the risks, I think the better we all are. So I'd love to have this be a very collaborative process.